Welcome to the Deep Dive. Today, we are cracking open one of the most intellectually compelling and, frankly, one of the most contentious names in the REIT space right now, Rexford Industrial Realty, or XR.
That's right. For anyone who's followed industrial real estate, our REXR has always been the sort of heavyweight champion of Southern California infill.
A company built on a concept you almost never see in institutional real estate. Just extreme structural scarcity.
And that scarcity is exactly why REXR commanded what you might call a Ferrari valuation for so long. But for the critical investor looking at it today, you have to realize the script has been completely flipped.
Completely.
We are analyzing a classic fortress under siege scenario. I mean, they own some of the most defensible industrial assets on the planet. But the central question is whether that almost mythical geographic advantage still compensates for the profound operational and financial headwinds we've seen from 2023 through 2025.
Exactly. This deep dive isn't about rehashing that old, easy compounding growth story. That algorithm is decisively broken.
Or at the very least, severely fractured. Higher interest rates just killed it.
So our mission today is to dissect that failure, that rapid deceleration, and then analyze the entirely new investment thesis. We're shifting from REXR as a high-momentum growth play to assessing it as really a deep value and capital allocation story.
A story driven in large part by the heavy breathing of activist investors like Elliott Investment Management.
Yes. We're moving past the hype and focusing on the cold, hard financial arbitrage and, of course, the very real persistent risks of operating in California. You need to know exactly why this stock fell off a cliff and what the path back could possibly look like.
Let's start with that foundation, because if you don't fully grasp the physical moat, you can't understand the premium valuation they used to have.
Right.
This is a REIT with a singular, almost exclusionary focus. We're talking infill Southern California, Los Angeles, Orange County, San Diego, and only the western part of the Inland Empire.
It's an immense portfolio, but it's hyper-localized. What is it, 420 properties?
About that, yeah, around 51 million square feet. And that singular focus is what makes them so different from their big public peers.
When you think of a Prologis or even a Stag Industrial, you're picturing these vast, new, big box centers for companies like Amazon, usually way out on the exurban fringe. REXR's model is not that.
Not at all. It's a completely different unit economic. They cater to smaller tenants, the SMEs, the local distributors, the last mile operators who absolutely have to be close to the port or the 22 million consumers there.
So they're not doing massive greenfield development.
No. Their value creation is through value-add repositioning. They hunt for B- quality assets, older warehouses with, functional issues, but in A+ locations.
And they're buying them from private, often multi-generational owners who are capital constrained.
Precisely. And then they apply institutional capital to upgrade them. That's the historical lever for growth. We're talking complex capital projects, raising clear heights from, say, 24 to 30 feet, improving the dock-to-door ratios, upgrading fire and electrical systems.
They're basically manufacturing a modern Class A building inside a location where you could never build one from scratch today.
Exactly. Now, their revenue structure is all triple net leases, which is supposed to insulate the landlord because the tenant pays for taxes, maintenance, and insurance.
But this is California. There's always a catch.
There's always a catch. And the nuance for a sophisticated investor here is that the sheer velocity of rising insurance premiums and property taxes puts huge pressure on the tenant's total cost.
So that, in turn, has to put downward pressure on the net rent REXR can charge. There's a ceiling.
There's a practical cap. It wasn't really a factor during the zero interest rate period, but it is now.
Okay, but even with that friction, the whole investment thesis is still anchored in that supply inelasticity. Let's dig into what makes that moat so durable, because that's really their only salvation in a down cycle.
Well, the first pillar is what we call the topographic fortress. It's just geographic determinism. Look at a map of Southern California.
You're boxed in.
You are completely boxed in. You've got the Pacific Ocean on one side, massive mountain ranges to the north and east, and then just dense urbanization everywhere else. It results in basically zero elasticity of land supply.
Unlike a market like Phoenix or Dallas, where you can just keep sprawling out into cheap farmland,
Yeah.
can't do that in the LA basin.
You can't. New construction is prohibitively expensive, it's politically a nightmare, and it often requires tearing something else down first. The market simply cannot build its way out of a high-demand situation.
And we have hard data on that scarcity.
We do. Even with the recent market softening, REXR maintained 96.8% same property occupancy in the third quarter of 2025. That is an incredibly sticky rate.
Yeah, that's way above the national average, which is hovering around 93, maybe 94%. Just validates that thesis of defensible utility. Tenants can't afford to leave.
Which brings us to the second, and I would argue most powerful economic pillar, the economic moat of drayage.
Okay, you have to understand this to understand their pricing power. It's all about the tenant's total logistics cost.
It's staggering when you look at the breakdown. For a typical distributor, transportation, fuel, drivers, maintenance is somewhere between 45% and 70% of their total logistics spend.
And the warehouse rent.
It's tiny in comparison, 4 to 6%, a marginal cost.
So if transport is 10 or 15 times the cost of rent, can you put some numbers on how that creates pricing power for RXR?
Sure. Let's imagine a tenant in a 100,000 square foot warehouse. Let's say their annual rent is $1 million. But their annual transport cost, moving containers from the port of Long Beach, is $15 million.
Okay, so a total spend of $16 million.
Right. Now, RXR comes in and raises the rent by a massive 50% to $1.5 million. That seems insane.
Sounds like a deal breaker.
But the tenant is economically rational to pay it. Why? Because RXR's proximity to the port, which handles something like 40% of all U.S. imports, shaves critical minutes off every single truck trip.
And if you shave, say, 30 minutes off thousands of truck trips a year, that could easily save you 5% on your total transport spend.
Exactly. 5% of $15 million is $750,000.
So they pay an extra $500,000 in rent to save $750,000 in transport. They're ahead by $250,000.
That's the arbitrage. That geographic proximity creates superior pricing power that's basically detached from the national industrial market. It's the cost of time.
Okay, let's pivot to the thing that always comes up with California, the risk. Skeptics always point to the regulatory environment, but paradoxically, it actually helps an incumbent like REXR.
It's a huge barrier to entry that shields them. I mean, the regulatory framework around land use is what makes new development so painful.
Painful is probably an understatement.
It is. The entitlement process, navigating the California Environmental Quality Act, or CEQA, it can take developers years to get permits.
And millions of dollars in legal fees and impact reports.
That expense and delay, that regulatory friction, is precisely what prevents new competition from entering their market. It reinforces the supply problem.
And it's not just development, it's operations too. You mentioned the WARE program. How does that work, and why is it more than just a tax?
The WARE program is complex. It basically requires large warehouse operators to reduce emissions from the trucks that service their facilities. They're taxed based on the volume of truck trips.
So you have to comply by, installing EV chargers or buying electric yard equipment?
Exactly. It dramatically increases operating complexity and cost. It's another layer of expense for the tenant.
So if you're a small local landlord, the kind of person RXR buys from this program is devastating.
It's a huge headache. But for REXR, with their institutional scale and capital, they can actually weaponize this.
How so?
They can industrialize compliance across their whole portfolio. They install solar, massive EV charging depots, clean truck infrastructure, not just at one warehouse, but across all 420. They generate WARE compliance points way more efficiently than a single tenant ever could.
And then they sell that compliance as a value-add service baked into the lease.
Precisely. So the regulation doesn't kill demand, it just accelerates market consolidation. It widens RXR's moat because smaller players just can't compete on that front.
So a classic case of regulation helping the dominant player. But we have to stress, and this is the core of the issue today, that despite all these incredible structural strengths, the financial model is under severe pressure.
The returns on invested capital, the ROICE, have just evaporated. And that's the pivot point for this new deep value thesis.
Okay, let's unpack that, because this is why the stock is down 40% from its peak. The old narrative was that REXR's advantages guaranteed double-digit FFO growth forever. That narrative is dead.
It was killed by rising rates, negative leverage, and just a necessary correction in logistics demand after the pandemic boom.
Let's get into the specifics of this broken growth algorithm.
The evidence is in the hard data. Let's start with funds from operations, FFO, the key REIT metric. Between 2019 and 2022, Rexford was delivering explosive, double-digit compound annual growth.
And what did that explosion slow down to for 2025?
For the full year 2025, management's midpoint guidance is about $2.40 a share. That implies core FFO per share growth of just 2.6%.
From double digits to 2.6%. The starkness of that is just. It can't be overstated. That's a growth rate that barely keeps up with inflation.
In a high-cost state like California, it's effectively a real inflation-adjusted contraction in earnings. That's a massive derating signal.
What about the other key internal metric, cash same-store NOI?
Same story. Cash SS NOI is the purest measure of the portfolio's organic health. During the peak years, we were seeing this grow at 8, 10, sometimes more.
Driven by those huge lease spreads.
Right. But that's moderated significantly.
Yeah.
In Q3 2025, it came in at 5.5%, and the full-year guidance is even lower, somewhere between 3.75% and 4.25%.
So the embedded growth juice is being rapidly squeezed out.
The tailwinds have died down. It's now a very light, sometimes contrary breeze.
Which brings us to what you called the canary in the coal mine, leasing spreads.
Cool.
This is the #1 forward-looking indicator.
This is where it gets really alarming for the bull case. In Q3 2025, REXR reported spreads of 26.1% on a net effective basis.
Which sounds pretty good on its own.
It sounds respectable, but the cash basis spread, the actual cash hitting their bank account in year one, was only 10.3%.
Whoa! That is a massive gap, a 16-point difference. You have to explain what causes that gap and why it's such a warning sign.
That gap is caused by concessions. A strong net effective number means they locked in a high contractual rent over the full 5 or 10-year lease. But the low cash number means they had to give away a lot to get that deal.
We're talking about free rent.
Significant periods of free rent, 3 to 6 months, maybe more, and very generous tenant improvement, or TI, allowances to help the tenant build out the space.
So the long-term contract looks good, but the immediate hit to FFO is huge. It tells you the tenant has regained all the leverage.
All of it. And the warning signs are even darker. Management explicitly warned of a negative 1% cash mark-to-market in certain recent quarters.
A negative mark-to-market.
Yeah.
That needs to be fully absorbed. That means for some of their expiring leases, the current market rent is actually lower than the rent the tenant was already paying.
It's localized rent deflation, even in their prime locations. And if that trend continues, REXR faces a definitive growth cliff in 2026 and 2027.
So those leases could start rolling down, not up.
Which would cause releasing spreads to go flat or negative across the whole portfolio, and organic FFO growth would just stop. It could even contract.
And compounding all of this is the complete seizure of their external growth engine. This was an acquisition juggernaut.
They bought $1.5 billion of real estate in 2024 alone.
And now that engine is completely idled. Acquisition volume is near zero in 2025 because the math just doesn't work anymore. We're in an era of negative leverage.
Exactly. Their cost of capital is now higher than the yield they can get on an acquisition. Let's just break down the math.
Please do.
REXR's cost of new debt is now around 5.5% to 6.0%. Their stock is trading at an implied cap rate or FFO yield of about 5.8%.
Okay.
But in the private market, premier industrial assets in Southern California are still trading at very tight cap rates, maybe 4.5% to 5.0%. Sellers haven't capitulated yet.
So if RXR issues equity that costs them 5.8% to buy an asset that only yields 4.8%, they're actively destroying value.
Instantly destroying 100 basis points of value on day one. That historical model of issuing expensive, dilutive equity to buy assets at thin cap rates is fundamentally broken until either private market prices fall or the Fed cuts rates.
Which forces them back to their other lever, the value-add repositioning. But even that's showing signs of stress.
Deeply worrying signs. If you look at the stabilized yields on their repositioning projects, this is their internal manufacturing of value. In Q3 2025, they stabilized 7 projects at a weighted average unlevered yield of just 4.4%.
4.4%. Their average interest rate on existing debt is 3.7%. If their marginal cost of capital is over 5%, they're basically destroying capital on these projects too.
That's the crux of it. A 4.4% return on a complicated multi-year construction project offers a negligible risk premium. It suggests their costs are inflating while their projected exit rents are falling. Their most important internal value creation strategy has become questionable.
This entire financial reality, the compression of every single growth engine, is the backdrop for the biggest development of 2025.
Absolutely. The reformed capital allocation framework they announced in November. And let's be clear, this was not a voluntary update. This was a direct capitulation to pressure from the activist investor, Elliott.
This is the Elliott pivot. It's the end of the founder-led empire-building era and the beginning of a focus on disciplined shareholder value.
And you can see that pivot most clearly in their decision to start a massive share repurchase program.
They authorized a $500 million program, and immediately executed $150 million of it in Q3 at an average price of $38.62. This isn't just a signal, it's a categorical statement.
It's management publicly saying they believe their own stock is wildly undervalued compared to the private market value of the assets. As we said, the stock at that price has an implied cap rate of about 5.8%.
And the physical assets are still trading at 4.5% to 5.0%.
So buying back your own stock is the most accretive investment they can possibly make. They are acquiring their own portfolio at a huge discount, which immediately boosts FFO per share and NAV per share for the remaining shareholders.
They're shrinking the share count instead of funding new, potentially dilutive acquisitions.
And critically, look at how they're funding it. They're using disciplined capital recycling, selling non-core assets. They sold about $54 million worth in Q3.
At what cap rate?
This is the key. They sold them at a weighted average exit cap rate of 4.2%. This is a textbook, beautiful, value accretive arbitrage.
You sell a non-core asset yielding 4.2% to buy back your own stock, yielding almost 6%. That 180 basis point spread is pure manufactured value.
It demonstrates a new rigor that was absolutely absent before. The empire building mindset is gone, replaced by a balance sheet optimization strategy.
And this is being cemented by a leadership change. The co-CEOs are retiring, and the COO, Laura Clark, is taking over.
Mrs. Clark has a strong financial background. She was a former CFO. This transition aligns perfectly with the pivot towards operational efficiency, G&A reduction, and capital discipline. It's the professionalization of the C-suite.
And the incentive structure is changing, too. It used to be about absolute FO growth, which encouraged that empire building.
Now the new framework emphasizes growth in per-share net asset value and G&A efficiency. This is a direct consequence of Elliott's involvement, and it ensures management's goal is now to increase your net worth as a shareholder, not just the size of the company.
And their greatest defensive weapon through all this is the balance sheet.
It is a fortress balance sheet, one of the best in the REIT sector. Their leverage, net debt to EBITDA, is just 4.1x. That's incredibly low.
So they have tons of dry powder.
Immense capacity, another $1 billion or $2 billion, to keep buying back stock or, if the market turns, to pounce on distressed M&A opportunities.
And their debt structure shields them from the immediate higher-for-longer environment.
That's right. 100% of their debt is fixed rate at a weighted average interest rate of just 3.7%. They have effectively insulated their cash flow from rate shocks, buying them precious time.
So what does this all mean for the investor? The case has completely shifted from a GARP story to a deep value, almost a turnaround play. Let's look at the numbers versus the risks.
Well, first you have to acknowledge the violence of the D-rating. At a $2.30 FFO guidance, the stock is trading at about 17 times PFFO. The dividend yield is around 4.2%.
And you contrast that 17x multiple with where it used to trade, often between 25x and 30x. The market has completely repriced this company.
It's stripped away the growth premium and is now pricing it like a B-quality industrial REIT, not a premier A-plus portfolio.
Yeah.
And that's where the value opportunity comes from.
Which brings us to net asset value, the NAV. The math suggests a pretty significant discount there.
Yes. Based on recent dispositions and a conservative 4.75% cap rate, a liquidation analysis would put the NAV per share well above $50.
So if the stock is around $40, that's a 20% discount to its underlying value, a big margin of safety. But how realistic is that NAV if the transaction market is frozen? Can you really realize that value?
That is the perfect question to ask. That $50 NAV is a theoretical number in a frictionless market, which doesn't exist right now. The quality is there, but the ability to realize that value is compromised by the regulatory friction.
So it's a long-term target, not a guaranteed floor today.
Exactly, which is why we have to detail these persistent, high-severity risks.
Let's start with the one that's freezing that transaction market. Measure ULA.
Measure ULA, the mansion tax in Los Angeles, is a massive 4% to 5.5% transfer tax on sales over $5 million. It has just paralyzed the market for large assets.
Sellers don't want to eat the tax. Buyers lower their bids to account for it, and so deals just don't happen.
And that creates huge friction for REXR's capital recycling strategy. It makes it much harder to sell those non-core assets to fund the buybacks. It weakens the whole arbitrage loop.
And you mentioned the WARE program again. While it's a moat widener, it also acts as a cap on rent.
Correct. Every dollar a tenant has to spend on WARE compliance is a dollar they cannot afford to pay REXR in net rent. It structurally caps rental growth because the tenant's total budget is finite.
Then there's the most immediate operational risk, actual market rent erosion.
REXR themselves reported that market rents in their portfolio fell about 12.8% year over year in the second quarter of 2025. That's a significant correction.
And that directly threatens the embedded growth story.
It evaporates it, and it makes those 2026, 2027 lease expirations incredibly vulnerable to rolling down into negative territory, which would mean FFO actually contracts.
We also have to watch the regional supply glut in the Inland Empire.
Yes, even though RXR is infill-focused, weakness in the IE, where vacancy is up to 8%, acts like a gravitational well. It can pull price-sensitive tenants out of RXR's core markets, forcing them to lower rents to compete.
And finally, the big macro risk, trade policy.
The ports of LA and Long Beach are the gateway for Asian imports. Aggressive tariff policies could structurally reduce import volumes, which would dampen demand for RXR's distribution space and hit their pricing power directly.
So, to synthesize all this, REXR is a very high-quality business going through a cyclical and structural crucible.
It has an undeniable asset quality and a fortress balance sheet, which provide a floor to the valuation. And now, management has been forced to embrace disciplined capital allocation to manufacture returns while they wait for organic growth to come back.
So let's outline the two paths forward. What's the bull case?
The bull case is that market rents stabilize by the end of this year. The structural shortage of land reasserts itself in 2026 and 2027. RXR uses its balance sheet to aggressively buy back stock at a 20% NAV discount, manufacturing FFO per share growth while they wait. The market recognizes this, and the stock's multiple expands back towards 20x or higher.
And the bear case?
The bear case is that rents continue to deflate, driven by the IE supply glut and regulatory costs. The mark-to-market turns deeply negative in 2026, leading to actual FFO contraction. Tenants accelerate their exit from California, and the stock re-rates even lower, down to a 12-14x multiple, like a low-growth utility. The NAV floor is there, but it's unreachable.
This investment clearly requires patience. The primary risk is all in that short-term earnings trajectory. So for a critical investor, what is the single most important metric to focus on over the next 2 quarters? What's the trigger point?
The singular most crucial metric to monitor is the cash releasing spreads in Q4 2025 and Q1 2026. Forget the net effective number, that's the long-term aspiration. Watch the cash number. If those spreads can stabilize above 10%, and if that gap between net and cash starts to narrow, it means their pricing power is resilient. It validates the deep value thesis.
And if they turn negative?
If they turn deeply negative, it signals prolonged earnings contraction is coming, and that NAV discount becomes irrelevant in the near term. The cash releasing spread is the ultimate real-time barometer of RXR's market leverage and the future profitability of this fortress.
A perfectly executed arbitrage requires perfectly timed monitoring. The map is set. Thank you for diving deep with us today.